Hello and welcome to the Core Reports Weekend Edition. It's been a very interesting decade of investing, and more specifically in the context of today's conversation, venture capital investing. So what are the big lessons that we can take away, the good and the bad, and how can those act as a benchmark or a direction for the investments that we will see and the potential outcome of it, including in wealth creation in the next decade? To do this, I'm happy to be joined by Mohandas Pai, Chairman of RN Capital, Chairman of Manipal Global Education. Mohandas Pai, as some of you may know, or many of you may know, joined Infosys in 1994 and is best known as being the Chief Financial Officer of Infosys in a very critical growth period, and subsequently now, as I mentioned earlier, dons the hat of an investor and a commentator. Mohan, thank you so much for joining me today on the Core Reports Weekend Edition. So I'm going to talk to you about a decade of venture capital investing, and the idea is to see what we've taken away as an economy, as a cohort of startup companies, and of course investors like yourself who've been in this space. But investors like yourself also have a slightly different lens, which is that you worked with traditional and mature businesses. I'm treating IT services as both traditional and mature. Profit making, started up with barely any capital, almost self-funded, so to speak, and then became the giant it is. And there are many such examples. So the contrast between that and, let's say, some of the maybe investments you've made yourself versus and what we're seeing. So this is broadly the scope that I want to cover. So let me start with the most recent trigger for this conversation, which is that you were taken on the board of Byjus as an advisor in June last year, and 1 year later you've stepped down. Now Byjus is in the public eye. Whatever has happened is quite well known. There is a problem with the company's accounts. There's a problem with the company's governance, and more importantly or significantly, almost all the investors, or actually the international investors who were holding board seats on the company, quit despite putting some $5 billion down. Then the auditors also resigned. So what does this tell you in a very broad sense?
Well, first of all, we are on the advisory board, not on the board. So,
Yeah.
and our agreement was for 1 year to work with him and try to help him, both Rajesh Kumar and I. So we've completed 1 year, so we are stepping down. There's nothing more to that. You see, the lessons from Byju are very clear. When you have a superstar CEO, and he is a superstar, he's done extraordinary work, very charismatic, great teacher, you need to have a strong set of people to work with him to make sure as the company grows, you improve processes, systems, and create structures. You cannot deal with a large company the way you deal with a small company, because as the company grows, process is important to bring in certainty. There has to be checks and balances. There has to be a very clear strategic intent, and there has to be proper allocation of capital. And for that, for a superstar CEO, you need to have a good board with strong people who can talk to the CEO and make sure that things happen the way it should. Because remember, I will not go by revenues in this case or any other case. I'll go by valuation. I mean, if you're a $1 billion unicorn, it's a big company. There are only 550 companies in the stock market who are $1 billion. Only 550. There are 5,500 listed companies. There are 18 lakh companies in the country. So you are a very, very small sample. And once you have $1 billion valuation, even if you have 50 million, 100 million revenues, I mean, you are a big company and there is so much at stake, so much money at stake, so much of investors' money in stake, and that deserves greater respect. So in this case, I think the board was very weak. It consists of only investors, and none of the investors, I believe, and what I understand and what I've seen, had any experience of building a company, growing a company, understanding the challenges, etc. Most of them are driven by increasing valuation. So valuation, increasing valuation, creating more money, spending that money became the primary objective, and it broke when the music stopped. For example, there's a massive growth during the COVID when everything went digital, etc. And when it stopped, and when you are trying to acquire more companies, and when the market is hot and the market cools down, then people back out. So a lot of things happen. But the basic message is, as the company grows in value, you must bring in processes, you must bring in proper teams or checks and balances, have independent people on the board, and investors themselves or the fund manager themselves are not the appropriate people for this kind of board positions as they grow, because Most of them don't have any operating knowledge or never run companies to guide the founder.
Right, and that's an interesting point you've highlighted, Mohan, and I'll come back to your own role a little later in the advisory context that you mentioned. You're saying that people who came in from Sequoia, Chan Zuckerberg Initiative, Russell Dreisenstock of Process, I mean, he's the individual, they had not run companies ever, or at least it didn't reflect in their role in Byju's.
It didn't reflect in the roles in Byju's. You ask them yourself, you check out their background. Because you see, contrary to what happens in America, in the US, many of the fund managers are operating people. And when they come on the board, they have operating experience, and that's how they can bring a sense of balance. Here, most of them are young people, MBAs, fresh out of college otherwise, which is good. There's nothing wrong with that because they're very enthusiastic, they understand technology, etc. They bring value, but do they bring value in growing the company? Do they bring value in governance? I don't think so. Where that requires, just the other day for a very big company, they said, oh, we're getting an independent director with a senior vice president of another startup. I mean, I don't know what that means. I mean, I wouldn't go along that pathway. I will get a battle-scarred veteran who has been through many crises, who has been in traditional companies, understand to bring balance. There's nothing wrong with younger people, but I think governance means that you have to look at your fiduciary responsibility. The fiduciary responsibility becomes more important. And sometimes investor interest and the company interest may not go in sync. Because the company may need to take a pause, company may need to slow down growth, company may need to build in processes where the investors will keep saying, I want valuation, I want valuation, I want valuation. I mean, I had investment in some companies where we were minority and the bigger players from the bigger funds just told the CEO, go founder, go spend money, go for the next round, spend money. They spend all the money, there's no more money. And it happened in a large number of cases. Because remember, all these founders in India are young people. They never run companies. Most of them is the first company. They're learning on the job. Or they have been managers in some companies low down, and they've never been at the top. Even if they've been at the top, they run smaller companies which never had any challenges. Suddenly they get money. Like, the first boom, SoftBank came, the very big manager, SoftBank came, just plunked in 100 million in that housing.com, and that guy blew it up. And then he raised another company and he blew it up. Third company, he got it from a big company in Delhi and he blew it up. Now, come on, give me a break. What are the board doing? So I think governance is extremely important because fiduciary responsibility, treating capital with respect to grow. We live in a competitive world. And we live in a world which goes in cycles. In the last 10 years in the startup industry, we've been to at least 4 cycles where euphoria started and then money poured in, valuation went up, and then suddenly fear took over, valuation fell, and value creation was not ahead of valuation, and everything fell down. Then value creation started, it grew up, and again the euphoria started, and then the money came in, and then it goes on. There have been 4 cycles, except the latest cycle it's been a long time, 2.5 years. Where normally is 1.5 years, 2.5 years because of the fact that overseas money is not coming in now, primarily because of fears about recession, interest rates, and all the kind of stuff, which is very, very huge. Once they settle down, money will come, and the cycle will start again. So I think we go through these cycles, and the cycles are not too long. And when these go through it, unless you are able to ride the cycles and keep enough cash in the bank, knowing very well that these are cycles, don't get carried away, don't blow up money, we treat money with respect. And look at the listed companies, Govind, look at the listed companies, right? All the big listed companies, one company just blew up because of bad governance. One company blew up because of bad governance. Another company just talking high, toned down, and put their head to the wheel and said EBITDA, and now they got some value up. They've been up. Another company got a very high valuation. They're stagnating because the valuation cannot be justified. And when you go to the markets, you have to justify the valuation by cash flow some point. 2 years, 3 years, 4 years. People give you time, but then when you miss something, you're down. I remember Govind, in 2000, Infosys was valued at 50 times sales and 200 times EPS. I remember that, okay? And we are valued at 50,000 crores. And the next 4 years, we grew earnings 43% CAGR. End of 4 years, we're still 35,000 crores valuation, but reasonable multiples, okay? But the point was that we grew the revenues, we grew the earnings, etc. And these people are not able to justify that. So the market will give them leeway, but end of the day, they have to deliver. And we must remember, when you got a high multiple, the market is very sensitive to growth. If they go tapers up a little bit, you give one bad thing, then you're gone. They just crash you out, and for you to come back is going to be very, very difficult because trust
Right.
is broken, and the show has moved on. It's like a circus show. The stock market is like a circus show, right? You see the show, everything fun, the fun is there, and once you break, you're gone, you're gone. They forget about you. New kid on the block comes, and the show goes on. It's a very crowded marketplace. We have to understand that, and I think that's
So,
why governance, processes, building it up, all this is very important.
okay, so I'm going to come to each of those in a moment, Mohan. But just one question I had. Now, when you joined as an advisory board member to or advisory member to Byju's last year, this is in June 22, June 23. Wasn't all of this already clear?
No, I think when we came, three directors that resigned from the board suddenly, and they had some borrowing from NBFC. They were all called in, and there was a big crisis because look, these three investor directors sat on the board and suddenly resigned and went public. I mean, what does this show? You put in $5 billion, you don't want to carry on, and you just walk away. I mean, what does this show?
I'm guessing it was
In a
because they were
crisis,
suspecting that some investigation was opened up or had already opened up. There was an enforcement directed investigation that had opened up. So which director will
look,
sit around?
look, look, whatever happened till that point of time, if you're a board member, you're culpable. You can't escape by
Yeah,
just walking away. Can you?
yeah, yeah.
Because you are looking at events which happened during your term. So what is the point? What you should have said is, you should have worked with the founder to say, hey, we have this crisis. We're forming a group. We're bringing in experts from outside to help us navigate this crisis, and we'll work with the founder to write it out. Correct? See, if the Adani thing happened, when the Adani thing happened, please remember that if the entire independent members of the board had walked out and resigned and gone, it will be a mess, right? Because the value of directors comes when there's a crisis. Value of a director, apart from the founder or the managing director, comes when there's a crisis. The crisis is where you must step up to the plate. You didn't step up, you just walked away for whatever reason. I mean, I don't want to argue about the reason or whatever it is, but that's the time when the company needs you most. And if you walk away and say, hey, not me, I'm not going to be there anymore, what are you going to do? So I think that shows immaturity, and maybe whatever it is, I don't want to comment on that. But overall, it shows that if you had independent directors and you could have worked together to say we will ride out the crisis, we'll work together, tackle the crisis.
Right, but then 1 year later, you too, along with the former State Bank of India chairman, have stepped down. So, what did
No,
you?
we are advisors. Look, we are advisors. We are not investors. We are advisors. We are not investors. We came in to help Byju out of emotion. That's all. And now the matter has gone to court. What further contribution can you do when everything is in court? When everything is in court, if the court has to decide, it goes on and on and on. What are you going to do? So the investors went to court, and it became a perfect storm. And let them now manage it.
Yeah. So let me come back to the role of investors. And you pointed out that these were really investors who were sitting on the board who did not have much operational experience, and they don't elsewhere too. Now, these investors are also responsible to their investors and
Yes.
globally.
Yes.
So why is it that
Yes.
they do not create that right governance structure when they move into a company and take such large positions?
Well, they should. I don't think they don't create it as far as I can see, because I don't think they understand the importance of governance. They don't understand the importance of why you must get independent people in the board, create check and balances, and all the nice stuff. Remember, Govind, Infosys went public when our revenues were something like maybe 3 million or something, right? I mean, immediately after 1 year or so, we got a good board. We are very so small. We got a good board. We had a lead independent director. We had regular processes. We announced results within 1 week, 10 days, all the things we did. We didn't have to do all that, Govind. We did it. Why? Because we said, look, we are listed. We have got a fiduciary obligation. We must discharge it. It can only be discharged if there are independent people who sit on the board and look at us and tell us we are in the right path. And we must create those structures and give them space. Now, we did that. That is what these investors should have done. That's why I think once a company startup reaches a level of valuation, let's say 500 million. I want to go by valuation, not revenues, because some may get valuation of 500 million with 10 million revenues, okay? But 500 million is a lot of money. It's a lot of money at stake. That's when you must start looking at independent directors, get good people who can help them create structures, create the kind of stuff, and make sure that the company goes on in a very different way with regular meetings, regular reviews, etc., so that there's proper capital allocation, etc., and the investors stay back. See, the investors in every startup are protected by the shareholder agreement. The company cannot do anything, many things without their permission. Okay, they're all protected. They got all the rights. The founders have almost no rights. They got all the rights. They don't have to sit on the board. They can be let us say, invitees. I mean, in our funds, I tell our people, don't sit on the board. You be invitees. You see what is there. You are well protected. At the right time, get third parties to come and sit on the board, pay them, and let them perform. And you have an interaction with them regularly because they bring greater value than what you can bring by sitting on the board. Because your rights are not compromised in any way. Your rights are not compromised. Your shareholder agreement, we say that budget may be signed off, capital expenditure should be signed off, everything should be signed off. We must discuss. So there is enough protection. But what these outsiders bring to the founders is the value of an outside opinion and mentorship. I mean, every founder also is grappling for answers. It's not that these founders or small companies have got all the wisdom because they attain nirvana. They're good people, bright people, but they're learning on the job. They got many dilemmas. I mean, it's a 24 into 7 work, and as you become bigger, the pressure on you becomes high, the stress on you becomes high. You don't know what to do, you don't know where to go, what to do. And then when you have this board, and possibly the board can be your mentors, you can go talk to them in the board meeting, they can question you, you understand, I mean, and discuss many things, then you're better off. It's a learning process for you to, right?
Correct. So Mohan, so when Infosys listed, which is about 30 years ago, roughly, now there was no concept of governance or corporate governance. Even Adrian Cadbury's report on governance was just being written at that time. People were getting to so whatever Infosys did, I'm assuming it did intuitively. Now the contrast.
Oh, it did because one, Govind, we are good people. Okay? We
No.
had people with some, listen to me. We have people with some maturity who understand when you go public, your responsibility increases. You are in the public eye. Okay? You got other people's money with you. Now, for our ordinary middle class people, taking money from others is a very worrying sign. You got to deliver value. People are trusted with the money. Please understand that. That's very important. Okay? And that says we have to step up to the plate. What do? We need boards. Get independent people. Give them the space. Review. Present to them. Listen to them. Make them work. You got to make them work. It's not that you had a board member. They
you're
had
right.
tea, coffee.
No, Mon, what my question is
voluntarily. No, I'll tell you. We didn't volunteer because we had a dream. We want to be the best in the business globally. Best in the business in terms of governance, in terms of processes, in terms of technology, in terms of people, in terms of marketing, in terms of campus, everything. We want to be the best. What is the global best? This is the global best. Beat the best. That's what the ambition, our burning desire was there.
Right. Okay. So now, if and this is again going back 30 years, N.R. Narayana Murthy had the vision, and he created many of these things, including board structures for Infosys. There was no real benchmark.
Well, I would say that all of us, Govind, all of us did it together. He gets the credit as chairman. I mean, a lot of us contributed.
Yeah. Okay. Fair enough. So, and you continued it. I mean, and over the years. So, and in that same spirit that it was first started. Now, my question, therefore, is in the case of Infosys, and all of this came from within the team, including yourself and all the senior stakeholders. But when you contrast that with, let's say, Byju's or many of these other companies, the sense I'm getting is that there is no such desire even 30 years later. There's no inbuilt desire to say that I want to be the best in governance. And if there isn't, then isn't it a lost case to start with?
No, it's not a lost case because the first decade of any new thing happening is a decade of discovery. This is a decade of discovery where everybody discovered themselves. The investor discovered themselves what works, what does not. They don't know what works, what may not work. They invest at a seed on an idea, on something which does not have a background, does not have any history, and they try to ride out the wave. A lot of money is coming in, and this creates its own challenges. And you spread the portfolio, you create a portfolio, spread it around many companies, and you work with them, etc. But the key differential is that the people who invest the money on behalf of investors, the fund managers, should have this passion that I'm going to have put in good governance to protect myself, and at least as a question of risk management. What are the risks when I invest? The risk when I invest is, yes, the technology may not work, the company may not grow, it may not create a sustainable revenue model, blah, 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 and the founders may come up short and all that. How do I manage the risk? Now, you must not kill the entrepreneur. You must not reduce their drive and energy and passion. But capital allocation, investment, putting in financial plans is very important, because that's the core. You can't just go on burning money, right? So for that, you need to have people who can bring in that kind of discipline and oversight, and that should be something the fund managers should do. For example, in many of our funds, where at least some people listen to me, I tell them that please bring in experts from outside, talk to them. I review 20, 30 companies every 6 months or every 3 months, talk to them, and many of them get scared of talking to me because I question them. You have this, do this, do this, do this. And I'm not going, I'm so shocked. I'm so shocked. I'm not able to understand why. There are some 10, 12 digital companies who are listed. When do they announce the results? After 40 days, 45 days, man. They're supposed to be digital first companies. They're supposed to have electronic. Why can't they announce the results in 5, 6 days? What is so great about getting the damn thing audited? We announced Infosys within 8 to 10 days when we were 5 billion, 6 billion revenues. HDFC announces within 16, 17 days. Reliance within 25 days. SBI within 30 days. SBI, 250 years old, 25,000. Man, they give me a break, man. These guys invest out of 45 days, 50 days, as if it doesn't matter. And they don't understand, if you're going to do that after 45, 50 days, you're living in the past. At Infosys, within 10 days, we announced we finished the quarter, we're looking to the future. The quarter is over. When the year is over, the year is over. You can't do anything. When 31st March is over, the year is over. Announce it, finish everything, get along, because life is about tomorrow. Life is not about yesterday. And none of them have the desire or passion to do all that. Then they come in with the new things, adjusted EBITDA. What is this nonsense, adjusted EBITDA? I had a fight with one of them, and he said, no, adjusted EBITDA, this, that. Yes, I said, SEC has a standard. SEC has a standard called adjusted EBITDA to come from the actual EBITDA, which has non-cash charges, to a cash EBITDA to show the cash losses. So remove the non-cash charges. Okay, they have a standard. India, we don't have a standard.
Can you explain that a little more for those who will not or may not understand?
No, because these people come with the concept of adjusted.
Yeah, go ahead.
Adjusted EBITDA. Adjusted EBITDA is the SEC has a standard in the United States which says once you have an EBITDA, which
that
is
earnings
cash,
before interest, tax, depreciation.
Yeah, yeah. Which is after cash and non-cash charges, and you want to come to show that, look, the actual cash position is this. You add back everything, all the non-cash charges, and say this is my cash-based adjusted EBITDA. That is to disclose to investors something which is important, cash flows, right? That is there, is well understood for all companies. In India, it's not well understood, because in India, in the market, people think adjusted EBITDA mane to adjust kar diya. Because the word has a history in India, adjust kar diya. They're trying to prove that here. Instead of that, they should have just said cash EBITDA. What is that? People understand cash EBITDA. They understand cash flows. They understand free cash in this country very well.
Yeah.
So they take a Western concept and try to trust it down. Doesn't happen. And and they give also my adjusted EBITDA, this, that, and all. It confuses people. Not that our analysts are not smart; they're extremely smart. Our analysts are the best, smartest people I've seen globally, because they pay too much attention to detail. They don't look at macro issues. The overseas investors look at macro issues. The micro is not so important. Our guys, go to 2 decimal points. Remember, Keki used to say 2.27% spread and all that. You're the master of that. So, and that's why the company did well. So now I think that's problem. And second problem is, some of them gave large stock option charges in the first 2 quarters after getting listing. How can it happen? Did you announce that right in the prospectus before listing? We have given these charges, we have given this stock option, restricted stocks, not market price. We have given the stock option, this will be the charge. They didn't disclose. I don't remember anybody disclosing. Remember, for some 4 or 5 companies, there's a big shock in the first 2 quarters when they saw the big ESOP. Now, how can it work? And many of them reconstitute the board a short while before going for listing. Now, 3 months before listing, you reconstitute the board and getting independent directors. What expertise do the independent directors bring to the table when they've not been able to study the company? To understand the company takes 1 year, takes 5, 6 meetings. They should have reconstitute the board 1 year, 1.5 years before that. gone through 3 or 4 periods of review. The prospectus should have been explained to the independent director, signed off by them because they bring some expertise, then got public. They didn't do it. It's a cowboy culture, right? But
So,
I don't hold anything against them because this was a decade of discovery. You're trying something new. The market is euphoric. You're going ahead, gungo, blah, blah, blah. Now the listing has happened. Many of them are lost out. Many of them are beaten. Yes, the many investors lost money. Some of the good ones are coming up. Right now there's clarity about who is going to be good, who is going to be there. So next 10 years should be the age of consolidation and growth, the age of discovery, the decade of discovery is, now everybody is there because all fund managers understood what can fail, what cannot fail. I think so. I
yeah.
hope so. Okay. The startups, when they go listing, they know that, look, these guys are all blown up. This happened. You've got to be careful. There's greater respect for capital, greater respect for becoming, not losing money, greater respect for profits, etc. Profit is not a dirty word anymore. It's a good word. They all want to
Yeah.
be profitable. And valuation is very circumspect. People are not giving you absurd value. They're very careful. There's a shortage of money. So I think there's a greater maturity that's coming right now with all this happening.
So, if I try and draw the links, Mohan, we talked about first, let's say, companies which are unlisted, and you have venture funds with their representatives sitting on them, or investor board members. In the case of Byju's, they've left, but in many other cases, I'm sure they're still around. The second step clearly for them is to somehow push the company, and which I guess is part of their fiduciary responsibilities, to go public, or at least because there is a public market which is very vibrant as it is right now, go and force a listing, so to speak, or at least push towards a listing. So now the problems or the excesses of the last decade in many ways are also getting carried through to this decade. If I don't know if Paytm is a good example of that, but there are several other companies, and some of them you've referred to indirectly already, saying that one symptom is when they take so long to declare their results. So then, while you're saying that we are moving from a decade of discovery to a decade of consolidation and growth, we're also still carrying some of the problems of the past.
Yeah, that's true because it doesn't happen on a cutoff date. It is a process. It's a process, right? It doesn't happen on a cutoff date. There's no falling off the cliff. People should learn. Look. If I was an investor, large investor from a mutual fund in all the digital companies, I will go question them and say, please declare results within 10 days. Because the longer you take the result, there's a larger is the chance of leakage of information. Please remember that, Govind. I, as CFO in Infosys, I was very scared about information leaking to the market. I was very scared every time. And we used to work very hard to make the information secure and keep it confined and make sure that we announce fast so it's all over. We don't have to lose our sleep. I don't know whether they understood this. They understand this well. Whether the more the delay, the greater chance of leakage of information, insider trading, inside information. Why do you want to fall a victim? You may not fall a victim, but why do you want to have a chance? It's not worth it. I wish the mutual funds go to them and tell them, please announce within 10 days, 15 days. And one of the big ones, I told him, why do you not announce it? No, sir. He said that auditors are not saying that we'll do it later. We got to work. I said, kick out the auditors, man. Sack them. Get somebody else. Who cares? The auditor cannot dictate when I want my results to be out. Correct? He's a professional. He's on a fee. We pay him to do his job. Let him do his job. I shouldn't be held hostage to the auditor. That's his problem. Let them manage the work better. So I think, Govind, you see, this is where maturity comes in, board member comes in. Now look, we had a crisis about some of these companies, Paytm, where the crisis, let me give the name. When that RBI thing came up, right? Now what did RBI say later? RBI just said this bank, this payment bank is going to stop. They can't accept anything, ban. But you forget to add, RBI had given them 22 months. This
Yeah.
matters about 22 months. 22 months is a long enough time. They never give me anybody 22 months. You know that, Govind. You watch the market. They given 22 months. And when it happened, I saw many young founders saying, RBI, who is RBI? Who is this? All kind of rubbish. With RBI in that mail did not say 22 months. They just said 22 months. 22 months, nobody gives. And in 22 months, what was the board doing in that company? What were the directors doing in the company? Why didn't they hold the founders' feet to the fire? Because when a regulator tells you something, you better be careful. And when the regulator is somebody who can destroy you, you better be more careful. Your business will go. Now the company is gone. Now what are you going to do? That means the regulator has lost trust in the regulated entity. The regulator is given a lot of time. Regulator asked them. Regulator said, "Chalo," because regulator doesn't care. Their job is to protect depositors or protect the public. They will take the responsibility. They don't care. Now you destroy the company. Who's accountable? The independent directors. They should. Everybody should resign and should be replaced. They should have stepped in. That's the government governance failure. And what happens to the parent company? The parent company had related party transaction. They should monitor that. They should be careful. And when this happened, they should have taken charge because the subsidy belongs to them. Did they do it? No. Or a material company, material investment. Who are the independent directors in Paytm? I don't know. Has anybody done it? You were in the Adani case, Govind, when the Hindenburg whole thing hit the ceiling and the stock price is falling, the independent directors should have stepped up to the plate and said, "We are forming a group. Here are 3 or 4 people. We will look at all this. We'll work with management and we will give all the information to the public and we'll tackle this." That will show arm's length because the charge of Hindenburg is against the management. The controlling shareholder and the management did this. Now you're listed. When you're listed, you're not a proprietorship. You treat the company like a proprietorship, personal property. That's not okay when you're listed. Correct? So when you're listed, you're different. Nobody knows who the independent. They never stepped out of the plate. It is the controlling shareholder who stood up and gave some reply and all the thing. And that CFO who lives outside said that this attack on India is so ridiculous. Right?
So no,
See,
but in the
lack
case of
governance.
yeah, but in the case of independent directors, I think one there is a legacy. The legacy is that in promoter-run companies, independent directors do not think that they're signing up to do anything independent. At least from whatever I've seen. How does one change that?
Govind, I understand what you're saying, but I don't think we should take that attitude. We must hold their feet to the fire. Now, independent directors should understand that their role becomes most important in a crisis. Okay? It is in a crisis where they must stand up to defend the company. And the crisis happened because of some management lapses. It can be a regulatory crisis. It can be a crisis of the CEO succession or the CEO getting contaminated. It can be a crisis of acquisition, right? Something like that, where they must step up. That is their job, or they must leave. They should resign and go. I mean, they're all people of self-respect, self-worth, correct? That is the problem. And now, why isn't the media and others holding the independent directors to independent directors bring it to account? Why is there no talk in the media, commentators like you saying, what the hell are the independent directors doing? They must all resign and go because nothing but a proprietorship. It's a sole proprietorship where the controlling shareholders who own the majority 70-75% is dictating everything, doing everything. What is the board for? Is the board to come and have tea, coffee? Why is there no questions asked by major investors and why commentators and the media about this problem? Is a governance problem. I mean, at the end of it, they came out and I think the valuation is up and all that. That's pretty good. But the fact is, you see, it is only in a crisis that there's governance. Remember, when Citibank was hit by the crisis, Chuck Prince and others had to go. And Chuck Prince made the stupid comment, remember, in Citibank as the chairman in the crisis, he said, "Oh, we knew about this option. We asked the risk people, what are the options? Are they okay? They said it's okay, so we said it's okay." Isn't it? Even for Greenberg, right? What is that? American Insurance, right?
Hank Greenberg.
AIG,
Hank Greenberg, yeah.
AIG. I mean, he ran the insurance company beautifully, but in the corner of New York, where a group of people sitting who were writing options. And they wrote all the options and sold it off and passed it on, except it went all around the world and came back to the same room. And it blew up. What is risk management? It's a governance issue. Where's risk management? Like Chuck Priest said, I asked my risk manager what happened. Is it okay? They said it's okay. I didn't understand it, so it is okay. See, these are all governance failures of proper risk. See, but one thing, Govind, easy for all of us to talk and make this statement after things are blown up. When things are live, that is where people must step up to the plate. At least remedy the situation to the best of the ability. Now, in all these cases, even in Paytm, what is the board doing? I don't know. I don't know who are the people on the board. They should have stepped up. Byju, they shouldn't have left. They should have stayed there because they were already liable for events that happened before, right? By stepping down, they're not going to improve their status anymore. So, in all companies, I think it's very important that independent directors stand up when there's a crisis. So, the learning in this startup is the fund managers have to think about all this. They have to help put the process in place because they are major investors. They are fiduciary agents for their investors. They must make risk management. They must do all this and learn to do all this. And I hope they learn. And I'm sure the next 10 years, hopefully, may be better. We always live with hope that the next future will be better than the past, but the future represents the future is the replica of the past again and again. We've been through cycles, Govind.
Right. So, last couple of questions. So, as an investor now in your own funds, are you, let's say, using some of these lessons when you look at potential entrepreneurs or entrepreneurs who come to you, and then maybe taking slightly different calls today from the way you were doing earlier?
Yes, as investors, we tell the founders, look, should not lose money. The money that you have as a loss should be the investment that you make ahead of need to grow faster. That's fine. You must respect capital. You must always have 1 year, 2 years cash in the bank. You must have proper budgets. You must have processes. You must have regular board meetings and analyze it. And want to come to a size, you must get people to come. Now we are asking some mentors in financial matters to work with our startup companies. And the founders are very grateful. They acknowledge they need help because they don't know how to cut costs, they don't know how to do many things. So if we get somebody from the outside, so we have put people and they're all agreeing, they're all growing up. And then the investors on the board also become more careful. They don't want to lose their investment, okay, because they'll be held accountable. There will be a lapse of fiduciary responsibility. So the dialogue has changed, the context have changed, and people are much more aware. Because remember, in the first 10 years, the failures were few and plenty only because of some lapses by founders like housing.com, right? Now, the governance failures have come to the fore. They understood the failures because of governance. Byju raised 6 billion, a lot of money. It's a lot of money, more money to the insurance. I mean, how can you blow up 6 million, right? I mean, you blow up 6 million, you vote through it. Now investors also are not pouring money. If investors say, we're not going to pour money, we're going to have end use, we're going to do this, blah, blah, blah. That's why in the markets, when you go raise money, end use is very important. Declaring end use is very important. The board members should declare this money was raised, applied for this, blah, blah, blah. There's oversight. And the SEBI has put in many restrictions, right? All that is good. But in the market, you're open. See, when you're listed in the stock market, your figures are out, you're open, people talk about you, people comment about you, analysts write about you. So the checks and balances are far greater. Even then, there are failures. Even then, there are failures. And the failures are fewer. But in the startup community, that kind of check balances are not there. They have to be provided for the investors themselves. And the investors should rise up to that thing. And it's very important. And I think, my hope is the next 10 years will be better because, we have we have learnings from the past. We have examples from the past. We didn't have examples of success, examples of failure, etc. And the fund managers hopefully are wiser because they live through this crisis and they understand it and they're much more careful, hopefully. But Govind, there are only two human emotions: greed and fear. Now, if 2 years back, we had $42 billion come in when we had 42 unicorns. Next year, we had 25 billion. Then last year, we had about 12 billion. This year, you may have 12, 14 billion. But the market of the US opens up, money starts coming, goes to 30 billion. Same thing will repeat. Same thing will repeat. The whole of human history in the financial market is greed and fear. Can you overcome that? Some may not. Can you hope that things will be better in future? Yes, the hope is always there. And maybe some of them will put in checks and balances to become better, grow more mature. It's happened even in the venture capital industry, right? It happened. Remember that famous snowflake or something where a Sequoia partner who saw his valuation go up said, we should never sell, we should hold this. They believed in that valuation. Now the market is tanked 80%. If they sold everything, they would have made more money. No, we will sit here, we'll get another fund, we'll do it. Because, people believe that life is a linear equation. Life is not a linear equation, right? But when we get carried along, you get carried along, I get carried along. Because why? Greed takes over. It's a human emotion, right? The market reflects the emotion of all the players. Data and facts and emotion. You know that. So I think, but the key thing is, there is some experience, there is some learning. Many people will take it, some people will not take it. Greed will overcome, will repeat it again and again and again. That is the life.
But the last 10 years have proved and provided an important benchmark in its aggregate for definitely the next 10 years. I think that's what's important.
People will forget. Govind, and the market is euphoric. People forget everything, Govind. You know that. We have seen the Arshad Mehta time. We've seen the Ketan Parikh time. We've seen all that euphoria of the past. Govind, what can we say? We can only write stories. We can only tell people. And hopefully, things will improve. Remember, we heard something like that, that MMS, some monetary policy, right? Some new NMS, new monetary policy, new monetary theory, where they said government can borrow at zero cost, so why should they tax? Let them run deficit, go on borrowing at zero cost when the cost is zero. Now, for the US budget, interest cost this year could be $1 trillion, up from $500 million. And 2 years later, it's going to 1.5 trillion. So 1 trillion increase in interest cost in 4 to 5 years. Where the money going to come from when you already have a deficit? These are all this new monetary theory analysts. They all disappeared now, but they said that, right? You can go on borrowing, printing notes at a zero interest. People are buying. Why do you want to raise taxes, run deficit? What does it matter? Well,
So the point is that capital flows are fickle or can be fickle, and therefore you need to be careful and not get led away with theories that drive such capital flows. If I'm assuming that's the conclusion.
that is true. And the only reality in life is free cash flows,
Right, right,
where you generate your own resources to survive, to good and thick, to thick and thin. When the things go well, you get great value. When things go bad, you have enough cash in a balance sheet to ride it out. Remember, Govind, in Infosys, we always used to have enough cash in the balance sheet to meet 1 year's expenditure with no revenues. It never happened except during COVID, there was the fear. It never happened for 25 years, correct? Suddenly, when COVID, once in 100 years, then, nobody was bothered. They had enough money to ride it out for 2 years, correct?
right.
Now, when you want to sustain your business, you got to make sure, because, when things go very wrong, there's nobody to give you the cash. It's like losing blood. You lose too much blood, it's gone. You're gone, correct? So you got to do that. But I think, but the bigger issue which I want to talk to you is, we are in the midst of the digital revolution globally. Now, out of 8 billion people on the planet, 5.5 billion people have a mobile phone, 500 quarter billion are on the internet. It's a new business model which is opposed to the global supply chain of the industrial revolution. And now with AI coming in, quantum computing coming in, cheap data processing through the cloud, and humanoids and robotics coming in, everything in the next 5 years will change, and the impact will be felt. The change has been happening for the last 10 years. Now 5 years, the impact will be felt. How do all these startups and our industry react to the impact? When business has become more globalized, business has become more volatile, and these people have to grow. So the degree for greater understanding, greater knowledge, and greater governance in the next 5 years. Because if you don't take certain precautions, survival will be more difficult in the next 5 years than the previous 5 years, previous 10 years for everybody.
Right. Mohan, we've run out of time. Thank you so much for sharing your thoughts, and thank you for, more importantly, being so candid with your thoughts.
Thank you. Thank you. Thank you. Thank you, Govind. All the best.
Thank you.